Welcome to Talk Tickers. We dive deep into the earnings calls that matter. Today, we're tackling Forward Air, ticker FWRD, their Q2 2025 earnings release, and the call afterwards. This came out after the market closed on August 11th, and wow, it definitely sparked a negative reaction right away. So our mission for you, the listener, is really to untangle this conflict. You've got Forward Air's management talking up operational discipline, margin expansion, arguing they're executing really well despite the soft freight market, but then the market sends the stock down over 5%. So we need to cut through that noise. Does the operational story match the financial reality? That's the key question here. There's real tension.
Yeah, and that tension, that divergence is exactly why the stock dipped about 5.2% roughly around the call time. The market really zeroed in on the misses. And if you only look at the headlines, it didn't look great. GAAP EPS was negative 41 cents. That significantly missed consensus targets. Quite a big miss, actually. And revenue, around $619 million, also fell short of the $628 million expected. So, yeah, if you stopped right there, you'd think things weren't going well at all.
But then you dig just a little deeper and you hit that counter narrative where the CEO was really pushing this story about operational health that maybe the market kind of glossed over.
Exactly. The operational strength is really the hinge point. Consolidated EBITDA, that's earnings before interest, taxes, depreciation, and amortization. It hit $74 million. That works out to an 11.9% consolidated margin. And what's really crucial for their story, that number is a solid $5 million improvement sequentially from Q1. That $5 million gain, well, management argues it proves the internal strategy is working, the cost controls, the selective pricing, even if it hasn't hit the bottom line on a GAAP basis just yet.
Okay. So let's unpack that operational story then. Mm-hmm. Maybe start with the core Expedited Freight segment. That's their higher margin business. Management kept talking about rigorous cost controls there.
Yeah, this segment is absolutely the engine driving their narrative right now. It hit an 11.6% EBITDA margin in Q2. And get this, that's the highest margin they've reported for that segment in 6 quarters. And just to underscore how fast that happened, that's a 500 basis point improvement just since the end of last year, Q4 2024.
Wow. 500 basis points.
Okay.
So for listeners, a basis point is 1/100th of a percent. Mm-hmm. So 500 basis points means what, for every $100 in revenue, they're keeping $5 more in profit compared to late last year. That is quick.
Yeah.
But is that sustainable, or is it just the easy cost cuts, the low-hanging fruit?
Well, that's the million-dollar question, isn't it? Management claims it is sustainable. Their argument is it wasn't just slashing costs randomly. It was a fundamental shift. Pricing discipline. They basically showed they were willing to let go of low-margin freight. The evidence, look at the volume. Tonnage per day was down pretty significantly, 12.7% year over year.
Okay, so less freight overall.
Right. But, and this is key, they got more value from the premium freight they kept. Revenue per hundredweight, if you exclude fuel, was actually up 1.8%. That suggests they held on to pricing power for the shipments they wanted. Management's message was pretty blunt. We want the right type of freight in our network at the right price, even if it means being a bit smaller for a while.
That makes sense. And it leads right into that shift in pricing strategy you mentioned, how they're handling the soft market. The CEO talked about avoiding the standard general rate increase, the GRI. Why is that?
Right, the GRI versus what they're calling the SRI, the strategic rate increase. It's a really interesting distinction. See, a typical GRI is, well, it's like using a hammer, a blanket increase. Hits everyone, every lane. In a weak market like this, that can really hurt your volume. Customers just shop around more aggressively.
The SRI is more like a scalpel then.
Exactly. That's a good way to put it, the scalpel. The CEO explained they're working directly with specific customers on specific lanes, making very tactical adjustments, sometimes up, maybe sometimes even down, but in exchange for keeping that volume steady. It lets them hold on to profitable business while still charging a premium where they have an edge, on those complex lanes. It's definitely a more disciplined way to navigate a tough environment and protect those margins.
Okay, let's pivot to the Omni Logistics segment. That acquisition has been under a microscope, right? Management seemed pretty proud, declaring the network integration completed. Sounds like a big step.
It's certainly a major milestone they wanted to highlight. Now, declaring integration completed, you always have to take that with a grain of salt, right? Is the garage really clean, or did you just shove everything into boxes? But the numbers do seem to back up that they've made real progress.
How so?
Well, Omni is now clearly contributing in a positive way. The segment's revenue is up $16 million year over year, hitting $328 million. That growth was mostly driven by demand in contract logistics, and crucially, the reported EBITDA for Omni. Up 47% year over year, came in at $30 million. That puts the segment at a 9% 8% margin. So yeah, it looks like they're getting past those initial integration headaches and improving profitability both year over year and quarter over quarter.
Okay, that's positive on Omni. But before we look too far ahead, we got to talk cash flow. EBITDA is positive, yes, but free cash flow is still negative. Minus $17.2 million for the quarter. Investors care about cash.
Absolutely. And that's a key piece of the confusion for the market, I think. While FCF was negative, it actually represented a pretty significant improvement compared to last year. And management made a point, a very deliberate point, to highlight a different metric: unlevered operating cash flow.
Unlevered operating cash flow. Okay, explain that. Why focus on the unlevered part?
Right, because it basically shows you the health of the core business engine itself. It strips out the financial engineering, essentially. Things like big capital expenditures for new trucks or, and this is a big one, the huge debt payments tied to that Omni deal. Unlevered operating cash flow ignores those.
Oh, okay.
So the CFO pointed out that on that unlevered basis, the company is consistently generating somewhere between $40 million and $50 million per quarter. What that means is the core business moving freight is actually quite cash generative, the negative free cash flow number. That's more a reflection of their investment cycle and paying down debt, not necessarily a sign the underlying business is broken.
That's a really important distinction. So liquidity isn't an immediate red flag then. They finished Q2 with, what, $368 million in total liquidity? That's cash plus what they can draw down.
Yep, $95 million in cash and $273 million available on their credit line. So they have breathing room.
All right, let's look forward then. Management's talking some big ambitions. What's the North Star for expedited freight margins?
The North Star, as they put it, is looking at their peers in the less than truckload space, the LTL carriers. Those guys, the really profitable ones, run at 18% to 20% margins. And management stated pretty confidently that they believe they can reach that kind of market margin over the next couple of years.
Whoa, okay. That's ambitious. They just hit 11.6%.
Yeah.
And if they got there by shedding volume, focusing only on the good stuff, how do they reconcile that discipline with needing huge top-line growth? They have that long-term target, right? $5 billion in revenue about 2030. Seems like a massive gap to bridge.
It is a massive gap. And the key to closing it, according to the CFO, is operational leverage. Pure and simple. They need the top line to grow again. Volume has to come back. But when it does, they absolutely have to hold the line on SG&A selling, general, and administrative costs. They feel they've done the hard work on optimizing costs during this downturn. Now they need that returning volume to flow through to the bottom line at a much higher margin, leveraging the leaner infrastructure they've built.
Okay, so that ties into the longer-term vision. Shifting from integration, which they say is done, to transformation, that's supposed to wrap up by the end of 2026. And that's where the cross-selling from Omni and tech enablement comes in to hit that $5 billion.
Exactly. But this brings us to probably the biggest question mark hanging over the stock right now, the strategic alternatives review. Investors were definitely looking closely for an update on that.
And what did they get? Sounds like not much.
Management was incredibly tight-lipped. Very firm. They confirmed the review is, quote, progressing, but flatly stated they won't give any more updates until there's anything of substance to report. They did reiterate their belief that the whole company, the collective whole, is worth more together than broken up. Although they did hint they might consider selling off one non-core piece. But the main message was clear. Right now, the focus is on making the combined company work better, not selling it off in pieces.
Okay, so tying this all back to the investor viewpoint, sentiment is still kind of mixed, right?
Yeah.
Cautious, but maybe constructive.
I think that's fair. Cautious, constructive. The market reaction, that 5.2% drop, shows it's still fixated on the backward-looking stuff, the gap loss, the revenue miss. But management is clearly focused on executing on the forward-looking metrics, the internal stuff, EBITDA, margin expansion, that pricing discipline we talked about. And, this whole narrative prioritizing margin resilience over just chasing volume, it's actually pretty relevant right now. In this soft freight market, investors are starting to reward companies showing that kind of discipline.
So thinking about catalysts, what could really shift the market's perception? What could trigger a re-rate for the stock? Get it closer to those ambitious LTL peer margins? What are maybe the top 2 or 3 things to watch?
Yeah, we need proof points, tangible evidence. First, I'd say continued sequential improvement in those expedited freight margins, Q3, Q4. They hit 11.6%. They need to show that's a floor, not a ceiling. Second, we need to see real, tangible cross-selling wins coming from that completed Omni integration. Show us the synergies are actually boosting revenue. And third, while Any sign of a broader market pickup would help immensely. An early cycle demand turn, maybe a stronger than expected peak season, that would really fuel the operational leverage story, letting that volume flow through at the better margins they've established.
All right, this is Talk Tickers, and just a reminder, we are definitely not financial advisors. But based purely on the call, let's float an outrageous but maybe plausible trade idea, especially given that stock drop, despite the better sequential EBITDA. How about this? A long position in FWRD common stock, but paired with a short-dated, out-of-the-money put spread as a hedge.
Okay. Walk us through the logic there.
The logic comes straight from those operational details we discussed. We think that 11.6% expedited margin maybe suggests they found an operational floor. So you buy the stock believing the downside risk from operations is somewhat limited now. Assuming, of course, the whole freight market doesn't just completely fall apart. The hedge buying that put spread is like buying some relatively cheap insurance. It takes advantage of the higher volatility probably caused by that uncertain strategic review. And it protects you against bad news from that process. So it lets you participate if the operational story keeps improving and the stock re-rates higher on margin expansion, while also managing the specific risk tied to that M&A uncertainty, where management isn't really committing to anything. It's basically a bet on the operations, with insurance against the strategic ambiguity.
Betting on the ops, hedging the strategic unknown. That's a sophisticated read, definitely tied closely to the call's narrative.
And that really is the core takeaway for you today. Forward Air seems to be successfully prioritizing margin and execution, even if it means sacrificing some volume right now. They are driving that sequential EBITDA improvement, even while the headline GAAP numbers look rough. But here's maybe a final provocative thought for you to chew on. If management can actually convert that consistent $40 to $50 million per quarter in unlevered operating cash flow, convert that into sustained positive free cash flow, how quickly does the market forget about this quarter's GAAP loss? How fast could the stock re-rate towards that ambitious 18% margin target then? That jump from cash generation within the business to actual free cash conversion available to investors, that feels like the next big hurdle FWRD needs to clear. That's all the time we have for this deep dive. Thanks for tuning in to Talk Tickers.